Hi, my name is Felix Frey.
And I'm ARKK.
We're here to find great trading opportunities that target 150 to 400% returns. And you? Well, you're going to help us do it every single day. So welcome. This is the Winning Picks Podcast. This podcast is for educational purposes only. Options Geek LLC is not a broker-dealer. Options Geek LLC, Felix Frey, and Marco Rajnica are not registered investment advisors. Keep in mind, options involve substantial risk and are not suitable for everyone. Please consult your own investment advisor before doing any trading. Make sure you read the full disclaimer at the end of this episode. Mr. Marco.
Mr. Felix.
How are you, man?
Good. How are you? How's it going?
Good. And just make sure this wire right here is good.
All right.
And how am I doing? I can't stop staring. I think I was staring all night at this AMC chart. It's incredible. I mean, it's literally incredible.
Yeah.
And they're at it again. And I always think about Braveheart, the movie Braveheart, when he's like, hold, and they're coming out. I mean, it's nuts. But I think the important lessons that we learned from back in January, February, things happen. Okay, so the next 24 hours, 48 hours, things happen, and it is in this vortex going straight up. But I would say that make sure you have a plan here. Remember what happened the last time, and it happens over and over. The machines can go down. So tomorrow you wake up and AMC is up 5. It's trading 28.29 right at 9:30, and all of a sudden Robinhood's down for 25 minutes, or E-Trade's down for a certain amount. So you can have not saying that anybody's going to sell or everybody's going to sell, but if you are playing this game of buy and sell here, then you might want to have some of those sell limits out there just in case you can't get into your computer, you can't get to the trading. I think it's important. I think it's important to be prepared for something like that because it happened before. Right. Now, the other thing to look out for is, again, the same thing happened last time when things like this are going on. What's happened? The volatility is raising in AMC. So the option volatility is raising. It's dramatic. It's a dramatic increase. What does that do for the people at a Robinhood or E-Trade, the people in the command center? There's rules. They have to post. They have to have enough cash to go through their risk measurements. And basically, they get risk tested every night, every morning, throughout the day. And when the volatility is at high, volatility is a component of this risk measurement. And they have to have enough cash to whatever the answer is, okay, for whatever the answer says it is. When that volatility increases, the amount of cash they need rises because there could be substantial losses. Now, the one thing that you could say the shorts are in cahoots with them. I don't know. I don't know for a fact, but they could, and they did. We said this while it was going on the last time, and we were right. In times like this, they I don't want to say but they like to tell people, hey, we're going to reduce the leverage, right? Now, let's say there's 1 million people on Robinhood and 700,000 or 500,000, half the people own AMC stock. They're still living within the other 500,000 people who have no exposure to AMC are still living within the house of Robinhood. And so Robinhood is trying to protect the whole house just in case, because the volatility is so high and the risk measurements are exploding and saying you need more cash. So they might say as a portfolio, as a whole, portfolio margin has to go up, but also individually, if you own AMC, your margin's going up even a little bit more. If they do that, that's a way to force sell. That is a way to force people to sell because you have to follow the rules and whatnot. Now, they all might do that. And again, in cases like this, again, they have to post margin with the Federal Reserve each night, and it goes according to whatever the volatility is. So when they raise volatility to 300, that means there's 20 to 30% moves each day. And you got to be careful. You got to be careful for that type of announcement because that's the only way I see selling happening, right? That if the people who own AMC are not, then they're saying we're holding to 40 or 50 or like GME 100, 200, they're not selling. Then there is also the company can't sell. They didn't authorize any shares. There's so you have 315 million people, 315 million shares trading hands, and it's 1 o'clock. That there's who's trading all that? It's probably computers and shorts jumping in, buying against each other. Because again, you got this pocket of people that they're just sitting there watching, the thing fly higher, and nobody's doing anything. So that's one thought. The other thought is, something, that we've talked about in the past as well. Citadel, they make good money here. You think that you're beating Citadel, but there's 1.4 million options traded today. They're like the toll booth, and they're playing that game. The other thing is, you gotta, imagine that Citadel knows where the most pain is for tomorrow. Where will the most pain be for these millions of options that are coming in and out? And they might just be saving it for 345 to come in with maybe a buy or a sell. They'll push it to wherever, if they're catching people selling calls here because they're juicy and say, oh, I can just, and they don't want to be taken out of the stock, those people are going to have to reach for the calls back. So Citadel is all knowing, right? They know the flow, they know what's going on. So they're probably keeping $1 billion of cash powder just for AMC to push it either up or down to whatever's going to hurt the most amount of people. So, keep that in mind as well. That's just another thing that, Citadel being probably has 60% of the flow on their sheets just knows where they want it to go. And this to them is just let it float around, let it do whatever it wants to do. But starting tomorrow, we know the only thing that's factual tomorrow about AMC is that X number of contracts are going to expire. And we know that there are Y number of people that own this many calls, and we know that there are Z number of puts that people own. So they have the balances, and now it's just going to be a situation where they can just push the stock, hopefully wherever they want to go. If they need it down a lot, that's when they lean on Robinhood to say, hey, increase margins, or we're not going to make it when our bid offer is going to go very wide. They do whatever they got to do. Who knows how it's actually done, but it happened the last time, and so you just got to prepare for potentially something like that happening both ways. If people are selling calls, like I said, and Citadel sees that, they'll push it up. They have no, they're not trying to play exactly where it goes. They're playing the volatility game, and they have a lot of options on their book, and they're just going to, they know that it expires tomorrow, and they're just going to try to capture as much money as they possibly can for tomorrow.
Right. Yeah.
Okay. So there you go. That's AMC. The other thing, in the news, this is going to be a fight for a while, but you see the difference between Biden's plan, 1.7 trillion, and the Republicans at like 900 billion bucks. We're $800 billion away. Biden's team doesn't want to push. They've already taken some out. And so the Republicans it's just going to be a fight for the next few months. So I don't know how that plays out in the market and what people will think about that, but that's something to watch. At what point does gridlock or things not passing cause this market to find another reason to go up or down? So something to watch. The other thing that I think is actually a pretty good upgrade, pretty interesting upgrade, is Goldman Sachs has been really bullish on oil, right? So they're talking about $100 oil again, getting back to where we were a couple of years ago, and saying that the world is not giving the oil price or future oil price enough credit and the demand that's coming. They're not giving enough credit on how much that can push oil. So they upgraded Oxy, and we were long Oxy a little bit for very similar reasons, which is basically, let's go back just to show you, because I think this upgrade, they were good with their upgrade on Exxon. So I think it's worth a watch. They upgraded Exxon right near the bottom. And but here's Oxy. Here's where it was. Oxy is a name that has a lot of leverage in the company. They have a lot of debt. They bought this ape in Anadarko. When they paid for Anadarko, they took on a lot of debt and have a lot of these assets. And the idea was they were going to sell the assets of Anadarko to take back that money, pay down the debt, and then have the businesses that they want produce a ton of free cash flow. Obviously, the last year put a dent into that whole plan. Mm-hmm. So now we have a situation where oil is trading back towards the 60s, 70s, and that's where a company like Oxy could actually produce money. So they did produce last quarter. They did show that they were making money. They used some of that money to lower the debt. The question is, can oil sustain that level, 60 to 70? Goldman's saying 100. So if they're saying 100, then Oxy's going to print money towards the end of the year, and that'll reduce the amount of debt, and Oxy could be literally a $40 to $50 stock if oil's trading 100. So you have this. I was just looking at this, and I'm saying, you have an option. You're buying an option on an option, right? So you're getting a lot of leverage here because there's leverage in the company, and then in the options, you can look at, let's say, like the Jan. Where are we? The Jan 30 calls are $2.80, call it. So 280. And if Goldman's right, by the end of the year, oil's trading 100, then this 280 is, could be 10. Stock could be 40 to 50. So it could be 10 to 20. So you have a potential, let's call it 3 to 1. And then if it gets to 50, which at $100, I assume this thing is going to start taking off because they'll be able to sell off their assets at good prices, and that free cash flow is going to be coming in. So it's going to change the game for something like Oxy, who's in trouble. So again, you got a 3 to 1 to a 5 to 1, 6 to 1 play, just and maybe you do half of it, a half of a full lot, and say, okay, well, this is my play. I'm not gonna look at it for another 4 months, and if it works, it works. If it doesn't, it doesn't. If the recovery is good and oil is going to trade up because we're not giving it enough credit, then this thing explodes higher. Now, that said, in the near term, I can tell you that some of these names, if you look on like Exxon, they don't look great. They don't look. I'm looking at, this is Exxon, so this was a leader. Goldman upgraded the stock right around here. They caught it perfectly. So you got to give them a little bit of credit there. I'm looking at sort of high here and high here, a little bit of a MACD. Well, it is a MACD diversion, but that doesn't mean it's going down. That just means that it should be showing some weakness, which it is, and you don't want to see it break sort of 53. So that concerns me. It's this MACD diversion. What you'd like to see is it to hold the 50-day and actually move sideways. It doesn't go that far. Move sideways for a little bit and not break anything like this 54 level. So you got 4 down, and then if it continues, this is gonna. You want this to circle back up this way, right? But right now, this is sort of a negative signal saying this is a little toppy. Okay, and that's Exxon. And Exxon, they all look very similar in the oil space. So that's what we have going on there. But I think the Oxy call is interesting today. So I just wanted to bring that to your attention. The last thing before we get into UOA is that Facebook, Dan Niles, who's Mr. This is Dan Niles. He looks young here. He was, during the NASDAQ bubble, he was the analyst that everybody, the semiconductor analyst that everybody listened to. So that was 20 something years ago, because he's around 98, 99. And he was the one pushing all the big semiconductors and whatnot. Dan Niles. He looks, besides the white hair, he looks as young as he did back then. So he's basically saying that he likes Facebook for many of the reasons that we're saying it. This is a pro. I have pro, but it's not here. But he's basically saying that Facebook reopening, the reopening is good because you have all these ads coming back with the airlines and travel companies. And obviously, we've talked a lot about the ads, and Facebook is one of the leaders here with Google and whatnot. So that should come back for Facebook. And he also mentions, just according to this article, he also mentions that he's long Magna, which is something we said yesterday. He said instead of buying the cars, companies with the cars like a Tesla, which he thinks is a little bit overvalued, he's actually trying to buy Magna, which is selling the parts, right? So it's sort of the idea we've been throwing out there. Everybody's chasing the cars. If it's something like it's new cars, it's a new company that's building new cars, that's one thing. Ford is not really building new cars. They're building, it's just they're switching cars. So it's really the parts that you want. The parts are going to be, or how you make the new cars is going to be what's different here. GM we like because of some of the parts is a little bit different. They had a lot of different parts to it that were very valuable. And they're in the EV. So Ford is doing well, and we're going to look at that. We can look at that for a second. But the it's interesting that he said this. We were talking about it yesterday, and anyway, I think it's a good quick read on a couple of the names that he's long. So that's what I got there. From what I'm seeing today, obviously the big news, AMC, Ford is trading well again. you got a lot of names here that GE is another one that is been picking up some speed here and looks like a little bit of a breakout. But let's look at what do we want to look at?
Let's look at Nike. I was surprised by this one.
Nike.
Yep.
I like Nike a lot, actually. A lot. I took a good look at it yesterday. The stock is down, has been down a little bit because of the boycotts. Chinese, it has to do with whether or not they want to buy. Nike wants to use Chinese cotton, so there's a boycott. Chinese people are boycotting Nike products because they weren't buying cotton, and more of a human rights issue that Nike was taking a stand on. I read an article that was interesting that said the flip side is I live in China, and the minute this news started popping up, the media picked up on the boycott. What they didn't pick up was that every store in China was Nike store was packed. Everybody was trying to buy as many shoes as possible because they thought that there was going to be a ban or tariffs were coming, and they wanted to get them either because they weren't going to be able to get them or they were going to be a lot more expensive in the future. Wow. That's the positive side. That's the flip side. So I like Nike, but what are we seeing here? You said you're surprised, so I get to see puts.
Yes, exactly.
Nike. Which puts are we seeing? Let's see here. June?
I don't think it loaded yet. Or it did. Okay, then June 4th, yes.
June 4th puts. Okay, next week. June 4th.
All right, yeah.
Let's wait for that. Wow. 11,000 Nike puts. That's a lot. What do they know? 79 cents. Okay, so let's see here. Right out the gate, 9.45. Stock started trading down here about 60, 70 cents. 79 cents, 23.2, 23.7, 23.6. Okay. Okay. Yeah, it looks like a buy. It looks like see how this came in. It was 79 cents. They paid 84. They paid 87. It looks almost like they were coming in to buy. Somebody was going to sell them. Somebody made the price and they said, we will sell it to you at 90 cents. So they came in, they buy some at 79 cents, a dime higher, 79, 84, 87, and then they put them up on the balance at 90 cents. So it does look like a buy. Interesting. So if you're buying that at, call it 85 cents on average here, you got to be thinking 132, 129 here. 130, it's a little bit too high. 130. Okay, so you got to be thinking 130 with the stock 137.61. So let's try to see that's interesting. I mean, that's pretty interesting. All right, let's go look at this. So this is, I mean, the stock's been trading well, and you have this, call it 125 line right here. Probably have something going on right around here too. 117. So sorry, this is 125. Okay. So here, and then we have, let's just call it this right around here, 147. So, and then you have something going on right here for the last month. I mean, it's a quick play from here to here, but it goes through the 50, the 200. So I don't know. I don't know why somebody would be doing that right here, protecting against the 50. It's above the 50-day. I don't know. It's odd. And maybe someone can help us here. The MACD looks pretty good. Like it's trying to kind of go back this way. It's interesting. I don't know why somebody would be buying those puts. So we'll keep that on the radar. That one looks interesting. It doesn't look like there's any reason. The market is trading strong. Things are looking good. And someone is betting for a sharp move. I mean, that's a sharp move in Nike over the course of the next 6 trading days, right? You're talking about they're looking for a 5% move down, 6% move down through the 50-day and through that. So I don't know. It's interesting. I don't know why somebody would do that. And to pick the expiration June 4th again, it's odd. I mean, usually usually if you thought Nike was going down and, it was going to trade down 6%, why not go to the June 34s or something, June 35s, June 34s, give yourself some time. So something is telling me that they're aware of something, or something's, potentially coming out like a negative news, or more into boycotts or whatever it might be. Okay.
Okay. Cool.
Yeah.
Cool. Now let me ask you, what's up with this GE? There's so much volume. I mean,
GE is one of these names. I want to believe it's a Wall Street Bets type of name too. They're probably talking about this. It's a name that is, it's a good. Look, it has risk. They're very levered to the recovery, and airlines is a big part of their business. That's been obviously bad. That's turning the corner. If you look 5-10 years ahead, more people, higher incomes, more airlines, more orders. India just made some very large orders, which was good for them. People have been warming up to this stock for a while here. It's not that it's unknown, but I would say that today, I haven't seen the news today, but again, it's let's just look at it real quick. You have, let's see here. Let's just move this over here, distract. So you have, this move up here like this. And then when it does this for a while, you're talking about, this is always a strong setup. It's one of my favorite setups. I mean, if you're watching here for a while, you know that this bull flag is something that is telling you after a large move, if it doesn't go down, then, and it goes this way, then, that's pretty strong. So now you gotta break through this, which it does. And you got to look at that volume, which is high. There's something to that move. So what can you say? I mean, the stock has had a big run. The guy, Larry Cope, he's a very well-respected CEO, doing the right things. And now they have the recovery working in their favor. And so you're going to be hearing more and more positive news. Biden with wind power, and that's GE. GE is right. GE, I think it was 4 years ago, 3, maybe 5. They made this decision to move towards power.
Right.
And they switched their whole book to energy. Like the future was power and energy and all the different things that come into energy. They're huge in wind power. And so, I think Biden's plan sort of fits into what they're doing, increases value for what they have. And so I think it's, it's a Biden generated type of name, and the stock is trading well, and there's been good news on the CEO. So G is a name that, let's just look back and see, give you an idea of where it's from. Although there's a lot of debt here, so you can't just, it's not really a great apples to apples, but at least to understand that GE, when I was growing up in the business, was, you can read the books, Jack Welch. I mean, it was the best managed company in the world.
Right.
And then they had a falling off. So this is Jack Welch retired, left this other guy. I think his name was Danaher, holding, not Danaher, I forgot his name. I forgot his name. But I think it was 2 CEOs after Welch, and you see what happened here. I mean, the stock just literally, this was GE for like 30 years and given a dividend, and then just fell out of bed. Jack Welch, I think, retired probably somewhere right around here, I want to say. Somewhere right around here, because they left it to the guy, and then the guy just fell apart. So this was a disaster. And yeah, I mean, it's starting to come back. You can't look at this here. It's has a lot more debt here. They sold off a lot of different assets. It was a much bigger company over here, but still people are thinking, this is a turnaround story. And if they get it right, and power's to play, and airlines are to play, and the recovery helps, orders are going to keep coming. It's really the airline business. If the airline business is good, then GE is going to do well over the future. Okay, so if you look at it like a Warren Buffett and say, he's not going to like the debt here, but you can say, all right, 10 years out, middle class growing, everything is good, then GE is a solid company. So we're seeing, that doesn't mean anything for really options in the short term, but, if it starts catching a little bit of momentum here, what do you got, the 15s here, all bought for 40 cents? That's a lot.
Yes.
Wow.
Yep.
So they bought them in the morning at 20 cents. They're already 40 cents. Wow. The stock higher. Okay, so they're buying these. This one, I don't know if I don't know if this is a name that they're trying to push. You know, it is hard to push GE. There's a lot of institutions owning a lot of stock in the name. You know, if the institutions are buying, then that's that's a good sign. They have been, but the next level, took the next step. This one's not like retail's not going to push this with a few $1 billion. This is a real name, real institutions that have been holding for 30 years. You know, looking for that. You know, just letting it sit and wait and get a dividend back that's good and sit on it for the next 30 years. So anyway, that's GE. So they're buying these. If you're buying these for 40 cents right here, then what's their price target here? 17. Yeah, 17. So $17. It's interesting, and I'd have to look what that was right there. I don't know. Maybe it's a flash crash, which may not give it that much weight, but let's see here. I'm trying to just look to see where there was some volume that started picking up right here, right? Because you have obviously the volume here, and then there was a long road here where the volume picked up around here. So if we just take this here, try to move it to like where it was, sure, it starts giving you that the volume starts picking up right here, 17 to 12. We're already breaking 14. This is the high. A lot of volume down here. These are the long-term holders. You know, this right here is long-term. The people bailing, and the people that are then the people that are buying here, the guys that are thinking it's 2019. Where's GE going to be in 2039? I'll start buying it here, buying. So that's the type of the holder you got there. And let's see here, breaking, so 13, and then you had this right here. So yeah, I mean, it could go 12 to 14 is $2, 2 plus 13, $15. But 15 is only air right here. So you really want to look sort of towards $16, 16, 17, 16, 18. So yeah, I mean, they're looking at 16, $17 here. Can I get there? Yeah, I could see it. $2, $2 plus 2 plus 13 is 15. With air here, there's nothing stopping 15 right here, right? So if it starts going this way, 16 is probably around the area where it's going to try to find.
Cool.
All right.
Awesome. Nice.
Let's see. What do we got? What do we got next?
Beyond.
I was going to say, do you see that? The Beyond? Beyond.
There was a lot of action there. Like
Beyond's been marching up here. I mean, we were looking at 100. They were call buyers, and I know a lot of people look at this name. It was crazy that this last move from down here has been pretty nutty. 100, 105 to about 145 here. So what I saw here in Beyond was basically someone was just rolling up, but I think it's important to see, where were we? June's what I see in Beyond. Let's see the 120s. Somebody had the 120s. Maybe it was right here. June 4th, next week. Yeah, I think it was next week. Right. Okay. So somebody had the 120s. It's already well above. Yeah, they were selling the 120 puts a couple of thousand times. So it looks like they bought those. They sold them a couple thousand times. And then they did this trade here, which was basically, looks like they're buying the 140s. And then they're selling the 145s, 147s. So that's 5. And then you can just add these two together. So, and divide by 2. So 3, call it 3 1/4, 2 1/4. It's 5.5 divided by 2, 275. So 275 for like the 147.5 calls, because this is averaging between 145 and 150. So he's playing 5 and 275 is 2 1/4. So he's paying around $2 to 2 1/4 for the 140, 147.5 call spread. Okay. And he sold 2,000 of the 120s at like $20-something. So net, he's just taking his profits and really just rolling into some call spreads here. Okay. But he's signaling to you that he thinks the run is pretty much done right around these levels. Okay. He's willing to play it for a little bit more. He'll get, approximately 2 to 1 on his $2 bet. So it's 2 to make 2 1/4 to make 5 1/4. And so call it 2.5, about 2.5 to 1, 2.4 to 1. he's signaling, because he's selling these calls, he's signaling it's over. I've made my money. Now I'm just going to leave, take some of that, a percentage of my winnings, and I'm going to dump it into these call spreads, and I'm going to wait. And if it comes back down to 125, I'll get active again.
Okay.
All right.
Okay.
But I just thought that was interesting, just because you're starting to see him say, he's literally telling you that the run is possibly over right around here. Just look to see in August. It's just been a lot of call buyers. I think people, looking, but it was all sporadic. Everything I saw else around the board was pretty sporadic. So that's beyond. What about here? I want to get into something a little bit, actually a little bit more. This is important. So this is going to be a very important lesson. I'm going to give you an important lesson. Like, everybody need their attention for a second. So what I'm going to tell you, at some point, you can thank me at another point in time, but at some point is going to save you potentially thousands of dollars, depending on how big you are. Okay. And it has to do with dividends. So yesterday, someone pointed out KHC, and they pointed out 100,000 options in KHC, and KHC went ex-dividend today. So that meant that if you were a holder of stock yesterday, then today the dividend is issued, and you're going to get paid that dividend. Okay. So if you saw those 100,000, and a couple of people looking 100,000, it has nothing to do with direction, even though they're buying calls. It has nothing to do with direction. That 100,000 is made up of basically a game that the professionals are playing to extract money from the average investor who's uneducated about options. Okay, that is essentially what's happening there. It has nothing to do. I'm going to show you the game. I'm going to explain it to you so you understand it, and I want to explain a little bit I just want to make sure that people understand when to exercise their call options. Okay, so let's discuss first the game. First, let's talk about what happens when there's an exercise. So the best way I can do it to show it live is to say, Marco, you're over there, and you're the buyer of calls, and I sold you the calls. Okay, so I'm working at an investment bank. You came to me and you bought these calls. Let's say it's $100 stock right now. Okay, but you bought these calls when it was $70. Okay, and you bought like January options or whatever, and leaps, and you had the 70 strike call. Now the option is the stock is 100. The option is worth $30. Okay, and the volatility is not that high, so it's not likely that the stock is going to go down to 70.
Right.
So these options are worth around $30 and a quarter. Say maybe the 70 put is worth like a quarter. Now today the stock is worth 100. So let's just remember that 100. You own, let's say, 10,000 options at the 70 calls. Now, when I say you could represent 1,000 people that own 10 lots. Okay, but right now it's just you, Marco, owns 10,000. Now, me, I am short the 10,000 options to you, call options to you, right? Over time, as the stock moved up, I was buying stock because I'm playing a different game than you. You went to the beach, the stock went up, you're happy, $30, you're sitting there very happy. Me, however, every day I was trading the stock underneath it, and by the time the stock got to 100, I've actually had to buy most of the stock to go up against the calls. So now you have 10 million options. You have 10,000 options, which is 1 million shares. I sold you 10,000 options. I actually had to buy 1 million shares over time, and I did. So now basically I'm long 1 million shares of XYZ stock, and I am short the 100 calls, the 70 calls to you. Okay, now that's a 30,000 foot view. In the middle, between us, there's an exchange, and the exchange is the SIBO or one of these options exchanges, but it's the OCC. Sorry, the OCC. The OCC is basically, you don't know. Well, you know it's me because you traded, but if it was 1,000 people trading 10 lots, they don't know who's on the other side. But again, we can not worry about who's in the middle and what they're doing. They're just sort of disseminating the options and the information between us. Okay. Now I got to introduce two other characters. Okay. One guy's name is Bill and one guy's name is John. John's on your side. Okay. John's going to be sitting on your end. He's going to be a buyer of the same calls that you have. And Bill is going to be someone who's on my side. He's the guy who's selling calls. Now, what's happening, the game that's being played. Okay. So we're going to introduce those two characters. And there's a game being played that they've sat at the table and they're going to try to extract money from you. Okay. So now you're the mark. Okay. Remember we talked about the dummy at the table, right? If you don't know what's going on, you're the dummy. Okay. You're the mark. You own those calls and a dividend's coming. Now, let's just understand what's happening. For me, I own the stock. So if the dividend passes, it goes ex dividend date, and I'm gonna get this. I own the stock. I'm gonna get it. Let's say it's $1 dividend. I'm gonna get $1 the next day on 1 million shares, which is $1 million. Okay, I'm short calls. Okay, call options don't move with the dividend. I'm sorry, don't get paid a dividend. Okay, and don't have to give a dividend. They don't have to do anything. It has nothing to do with the dividend. It just has to do with the stock price, the option. Okay, so what happens to the stock price tomorrow? It goes from 100 to 99. So my calls are going to lose $1, right? I'm going to make $1. The calls are going to lose $1, but I'm short them, so I'm going to make $1. Okay, my stock is going to lose $1. Okay, I'm long 1 million shares. It goes down by $1. I lose $1. So net, that's even. But I collected $1 in dividends. Okay, so those three parts is what's happening to me. I collect $1, and then my stock and the options, they both move the same. So I actually, I don't make any money there, but I do take in the $1 million if I'm there overnight. You, however, if you don't exercise, you only have call options. What happens to your call options the next day? They go down by $1. So net, what happened to you? You lost $1 on 1 million shares or 10,000 options. You lost $1 million.
Wow.
Okay, you lost $1 million because you didn't exercise, because the calls only reflect the price of the stock. They don't reflect anything about the dividend. So I'm sitting there and I'm waiting because I know that you don't understand options, and I'm just sitting there waiting to collect my money because I know that you're not gonna exercise, or I have a feeling that you're not. Okay, now that's the game. If you don't exercise, you actually transfer $1 million to me on 10,000 options. Okay, so now the game that's played is Bill and John just sat down. Which side was over there? You had John. John was on your side, or Bill was on my side? So John's on your side. Let's John's on your side. Bill's on my side. Bill and John trade the night before this dividend's about to happen. I'm sitting here going, okay, I'm ready to see if Marco's going to exercise or not. If he doesn't, I make $1 million. Bill and John sit down at the table and they make a huge trade. They make a trade of 90,000 options. Okay, 90,000 options, and all they did was buy and sell the option. That same option, the 70 strike, the same one. Well, what happens? Well, that night, Bill on your side, the guy sitting right next to you, he exercises 90,000 options. Okay, you don't exercise. Okay, so now I'm like, I was right. You weren't going to exercise. The problem is Bill and John came in with playing this game where 90%, 90 out of the whole 100,000 options in the pool were exercised, which means that the OCC right in the middle, the way they disseminate who, which ones were exercised and which ones weren't, is they take that percentage. So 90% of all the options that are on the table at the 70 strike calls, they were exercised. That means me, Felix, okay, I lose 90% of my options that I had, right? I lose 90% of them. That stinks. I was expecting to get 1 million shares times $1. I only get 1,000 shares times that. So I make 100 grand on your mistake. But Bill and John, who just sat there, John now gets 90% of his shares exercised, which means 81,000 of John. John's sitting right next to me. He now has 90,000 share options that are short. For 1 day's work, he literally sat there, got 90,000. 90% of his options get exercised, which means he's left with how much? 90% of 90,000 is 81,000. He's left with 9,000 options that didn't get exercised. He makes the $900,000. I make only 100. And he just came in the last minute one day and said, here, Bill, you go sit over there. I'm going to sit over here. You exercise. I'm on your side. And as a percentage, we're going to take the lion's share of whatever Marco, you're the dummy, you're the mark, whatever Marco doesn't do. You understand?
Wow.
You understand that game?
Yes. So that's what happened in KHC.
So whenever you see these dividends and the night before the dividend, and they have to do it on big dividends, meaning they have to do it on dividends where there is a big, payout, right? Because you're playing a percentage game, and you will see hundreds of thousands of options trade, like AT&T, ExxonMobil. These are large dividends. What you need is two things. You need a large dividend. One, you need the X date coming the night before. Two, the day before, and you need a lot of capital to do that trade because Bill and John don't just trade the 70s. What they usually do is they trade the 60-70 call spread, so they don't have to put up that much money. So they actually trade the 70s and the 60s. On the 60s, there's nobody there, so Bill exercise, or John in this case, sells the 60s. So he John buys it. So John exercises all 90,000, and Bill says, fine, that goes away, and he's left, and then we're just left with the 70s where you're involved. So you see how they jumped in, and that's what they do. That's a professional way to play this dividend game. And one of the biggest players is Susquehanna in that game. Look, they invented this game. It's smart. The way they're not trading with themselves. You can't trade with the legal issue is that you actually have to have two legal entities trading with each other. But that's what they do. It's not an easy, you need a lot of capital. It's not always, you got to spend a lot of money on software finding the pockets. Again, what you need is the X dividend, you need a large dividend, and you need a strike, right? That is in the money that retail investors, the average investors, uneducated investors were buying and that they're still holding. So someone like Citadel will know exactly where those are, right? The night before the dividend, they say, look at that one, look at this one. And each open interest with a lot of open interest, a lot of retail, that would represent dollars. They would say, there's a $1 dividend, there's 10,000 contracts, that's $1 million up for grabs. Now, some retail investors will know, and they'll say, okay, we got to get out of this. Now, the question is, when do you exercise? Because that's the next question is, when do you? So I'm going to teach you very quickly when you exercise. Essentially, in this game, you're really only going to exercise when an option is deep in the money. But that's just the first criteria. The call option, not the puts, call option. Puts too, but it's got to be way in the money. It's not good. You just focus on the calls. Call and the dividend. Call options, okay, deep in the money, okay, and essentially the time value that's left in the call option has to be lower. To exercise has to be lower than the put value of that same. So in this case, the 70 calls we're talking about in our example, we said the option was worth 30 and a quarter. There was a quarter of time value. The question is, how much is that 70 put worth, right? Because when you exercise, you're giving up the optionality, which means you're giving up that little put, that value of the put. So you got to compare the value of that put and the time value of your call option. In our case, it was a quarter, and I have to compare that with the put. Now, that's really the game. So really, and another way, an easier way to do that is to look at a lot of these brokerages. They have a delta there. When you're looking at your option, if the option is 100 delta, okay, 199, 100, then it's likely that it's an exercise. So that's one check. You can just simply go, what's the delta of the option? If it's 100, okay, the second check would be how much time value is left. In our case, a quarter. How much is the put worth? The 70 puts only worth 10 cents. All right, I'm gonna exercise that trade. I'm gonna exercise that option. Okay, so that's really what we're looking at. It's basically how much is the put worth, because that's what you're giving up.
Okay.
All right.
Nice.
So
nice.
There's a lot there, and I really wanted to explain why you exercise, and then this game, because you see it a lot, and a lot of times people say, "Oh my God, there's 100,000 call options in KHC or in this or that." You just basically, if you look on the board here, see these dividends, they happen tomorrow. So yep. Goldman Sachs, L&T, McDonald's, Nike. Some of these options, some of this options volume here is probably playing this game to capture the dividend. Okay. And they can do it in January option, like way in the money January options. They can do it in. So you can sort of disregard a lot of the volume you see in these names on the call side in the money options.
Okay.
Okay. Is that fair?
Yes. Nice.
All right. So that's how look, there's many times people they're trading, they have a 20 lot or a 10 lot and it's in the money and they don't exercise. 1,000 options, you lose 80-cent dividend. That's $800 that you would lose. And there's no recourse. You didn't exercise and you're supposed to exercise, you lost $800. So when you exercise, just remember me and remember that you learned that from me, and I just saved you a lot of money because it is a lesson people don't learn about the dividend exercise until one day they say my account's down $1,500 or $2,000, and
Right.
what happened? This is impossible. I didn't even trade, and nothing moved, and there's nothing going on. Every option is exactly the same, but it's the dividend that you didn't do what you're supposed to do with the option, and you just lost. You lost money, and there's no recourse. Okay.
Wow. Okay. Yeah.
All right.
That's great. I wonder if anybody in the chat actually had this happen to them. That would be interesting, you know.
Yeah, maybe be where's Dwayne? We'll try it again. We'll try it again, but go look at it a couple of times, and then you can ask me a very direct question, Dwayne. It's not the easiest thing to it's definitely not the easiest thing to understand and know, but you know, I think that it's important. It's important to understand, let's say, and it will save you money when there is a dividend. All righty.
Okay, cool.
Awesome,
Nice.
man. All right,
Nice.
cool.
By the way, everybody's screaming this AMC. It's almost up to $28.
I'm looking at it right now.
Yeah,
Hold on, let me. Where is it? Right, 27.
73.
Wow.
Yeah.
27. Holy cow! Is that right?
Yep.
Well, people are making a lot of money, so that's always a good thing. Wow, that's crazy. That is absolutely. This is like GME Part 2. But all right. So look, that it's really an important lesson. It's one of the most important lessons for retail investors that they don't understand. So if you have questions, you can ask me questions tomorrow. But go through that a couple of times. Go through exactly what I was trying to say, and then we bring back those questions tomorrow, and we can talk about it. It's really important to understand, and it's really important to get it right, because it will save you a lot of money over time. Okay, you don't want to make it's the dumbest mistake you can make in options, not exercising when you're supposed to, or just getting out. You can either do one of two things. If you have a call option and it's about to you can either roll to another strike, but you have to get out of that one. That is an exercise. Get out of that, get into stock, or get out of that and get into another call option further out.
Okay.
All right.
All right. Nice.
All right. Good.
Thanks. Awesome. Let's
keep
it moving. Let's see what's up. Let me throw you a curveball, actually. Let me throw you a curveball with Palantir. I just want to ask you. This popped up, and Sue mentioned it.
Yeah.
In September, I'm seeing some puts, but I'm not sure if it's buying or selling.
What's going on in June 1st? Palantir, this is like a very passionate company. Another one that's people are very passionate about this one. Okay, this is 22 calls. Let's see if this is. Okay, a lot of back and forth there. But in September, which one? September.
19 puts. Mm-hmm.
Yep, let's take a look. Oh, there you go. 6,000. See this? It's like I look at it and think, when I first look at it, it looks to me like, okay, this is like a very pointed play for whatever. It's like they know exactly what they're doing. But it looks here like, let's start from the beginning here. So when did it trade? Let's see the volumes. Biggest volume at 12:15. 12:15-ish. Okay, so let's get to. Sorry. All right, walking into here. This is where the volume is, right around 12:08-ish. Okay, so we're trading 126. This is nothing. Then offer. Okay, 127. Offer. As the time's going, they're paying the offer. So it looks like a buy. Doesn't look like a buy to you?
It does, except for the premium. It was going down. That was my only concern.
The premium was going down. I actually see the premium kind of going up here, right? 27.20. I see this going 54.8. They're paying 126. So they come in, they pay 127. The first decent lot, it's like they pay 127, 126, 26. Okay. I see what you're saying. 125 offer. But let me look at the stock here. 22, 54.8, 54.9, 54.8, 7, 54.8, 54.5. It's close. Let me look at this again. The first one, think about it, 127. I pay 127, 54.8. Stock goes up here, which is it's counterintuitive because you're buying puts. 127, 127. Stock is trading up. Yeah, okay. So it looks like I think you're right here. It looks like a sale. Very good. It looks like a sale. Looks like a sale. It looks like if they were paying the offer here, you know, at a time, it's a decent amount. So it's, at the time, the stock is actually going up, which would mean they would be selling it. So it looks like they've been selling it, getting down, you know, on the offer, on the, you know, sell it at 127, sell it on the offer, sell it, leave it on the offer. It's getting taken because the stock is moving up here.
And again, that's why the bid ask is shaded.
Yeah. Right. Yeah, that's interesting. It's counterintuitive because it's puts, but essentially they're trading puts here and the stock goes up, which would be if you're selling it. And then here, if they were buying it the way initially I thought, then this vol should have gone up, but instead the implied vol was actually going down. So that's the easiest way to think about, you know, how it's looking. And then afterwards, you see how it goes down, 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 and then after the trade, it looks like it's traded back towards 55.8 a little bit here. But yeah, I would say that it's probably a sale. There's no open interest there, so somebody's taking a stab there to say I'd get long at that level.
Right.
Yeah, I would say it's a sale.
Okay, cool.
All right. What else we got? HOG. Right. Did you see this HOG?
Yes.
So HOG, you know, I had a look at it yesterday, and you know, on the stock is interesting. So let's just take a look at here. I mean, we saw that they were buying 1 month, and then they bought it, and they a couple of days later they rolled out to a different further out. But essentially, they had bought some call spreads right around here on April 28th. Okay. So on April 28th, which is right around here, they bought some, let's call it here, they bought some call spreads. Okay, they bought the 55.60 up here, 55.60. And stock came off. Notice this level right here is interesting. So there's buyers here at the 43 to 45, there's buyers. Stock comes off, and then we saw in the last couple of days, we saw buyers of what were they buying? The 48s, and then they rolled from in June 4th next week, and then they rolled from June 4th to June 18th. So they're getting long calls here and the 49 calls, right?
Yes.
Today they're actually just selling these calls that they were up there. But I just thought that it was interesting. So on the 28th, they bought them here. The stock, almost like, you got to think of it like a placeholder, right? The stock's moving higher. They buy these call spreads, and then what happens to the stock? That showed weakness for 2 weeks directly after the purchase. I don't think that's coincidence. A lot of times you'll see these types of trades where they're buying calls. People then chase after that, but really what they're doing is they're just putting a placeholder there so that they can actually sell the stock, right? The stock, they probably got long. Here's the volume over here. Here's more volume here. They either got long here or here, right? And now they're thinking, okay, the stock's up a good amount. Let's let some go. But in the meantime, just in case it keeps going, we'll buy this placeholder. Trades down 10%. And, you know, maybe they're buying a little bit more here, right around this level. Okay. But now they're getting long right here. And that's what we saw yesterday, the 48s and the 49s. Today, they're selling the 55. Where's HOG? They're selling the Julys that they had on as a placeholder, the 55.60s. They just came out. It's so far out of the money now that it doesn't register. But it's the 55.60 call spread that they're getting out for. The other one is pennies for about 50 cents. So nice. And they paid 88 cents, and they're getting out of that. But they got into the Junes yesterday, so they're just reshuffling 48, 49. So they got into these yesterday. So they're reshuffling. I think it's good to see how stock moves. Stock does this. They're probably thinking to sell here, sell stock. So they are going to sell stock. So they sell stock, and then they buy these 55.60 call spreads here just to kind of have something. Stock goes up, they still own them. As the stock comes back down, now when the stock hits, because I think they bought them right around here, when the stock hits, call it 47, they start buying the 48s, and then they roll them out to get a little more time, 48, 49 calls. So they're using leverage here, as opposed, they switched it. See how up here, the stock was up here, they were using leverage up here, but that was just because they wanted to get out. Now they're using leverage here, right where the stock is, which is more interesting, right? The stock holds, you got a 45, 43, and they want leverage. So on a reopening, this could actually make a nice move. It's constructive. I like it. It looks like somebody's playing for leverage right here.
Cool.
Okay.
All right. Nice.
Good. Anything else?
Yes. I have FedEx, Verizon.
Okay.
And then one you really like, and that's a Roblox.
Let's do FedEx.
Okay.
FedEx. So FedEx and UPS. These are names. I mean, look, we were talking about FedEx and UPS for a while, a couple of months here, back in March, right? And the story doesn't change. I mean, this is a long-term story. Right around here is when we were starting to talk about, I think even maybe beforehand, let's call it right around here. How is it possible that the two biggest logistics companies are going to only make small margins and let everybody in the world use them and make all the money for themselves? They're not dumb, and the U.S. Postal Service is not a great service. It's just not a great customer service entity. And, it's FedEx and UPS, and they spend so much, billions and billions of dollars to build out their systems to do everything. And they make pennies while all these stores are making their money. Now they're fighting as well, but it becomes an extension. Once the UPS and FedEx, once their logistics system, which is what it is, transportation logistics system, becomes 50% of your business, they want a slice of your business, right? Just like anybody else. Like Facebook is, they know what your margins are when you advertise. You go advertise at Facebook, they're going to get a certain amount of your business. They're going to take it. You're not going to know how, where, because it's all done digitally, but they'll take a certain percentage. Same thing here. They're looking at it and saying, we make pennies on the dollar, and there's no way we're going to do it. So we were talking about hike in prices here and just a different approach on how they were going to, do their business. And we saw that with UPS. And I'm sure you've seen it here. What are you seeing in FedEx? Probably Colvine, I would say.
Yes. It's a weird trade. You're going to have to take a look at it because it's getting out of spreads, getting into some new spreads.
Getting out of spreads and getting into new spreads, yeah. This? 310. Okay, so the 310. So I see open interest here. Looks like they're selling half of the 310s and half of their 330. So they have this call spread. 310, 330 call spread. Most likely, I'm going to assume that they bought the 310, 330, and now they're getting into the 312 and a half, 340. I think it's a dumb trade, but they have a lot more money than I do, trading, $5 million at a clip here. Why would you just reduce it? Just reduce the trade by a little bit, and or just take some of this off because you think it's going a lot higher. See, what they're really doing is they're saying, we're going to move this up $2.50 and we're going to get $10 here, right? Because they think it's going to go up. But if you really think it's going to go up, just sort of reduce this a little bit. You don't, this $2.50 is not going to make that much of a difference. Capiche?
Yeah, makes sense.
Okay, so yeah, I like it. I think, UPS has got an analyst meeting coming up in June here. And I think that, let's see what we got. UPS. June, let's see, July. I think it's a couple of weeks. The exact date skips right now. 4,000 here. Maybe it's in this week right here. June. I don't know. I don't remember the exact date that the analyst meeting is, but she's going to come out with her whole plan in the next couple of weeks. She's the woman who, ran Home Depot. She was a CFO at Home Depot, so she knows her numbers. She's ran a big company. The stock, what do we say about a stock like Home Depot take a look at what it's done. Let's take a look at Home Depot just because I visually saw in the corner of my eye over there. We've been looking at these type of charts for months now. Is this bullish or bearish? I mean, stocks go like this. They're supposed to go up and down, right? Look at this, sideways.
Very bullish.
Okay.
Yeah.
So that's pretty bullish. That means it just jumped from 175 to 215 and nobody's selling it down enough. That means people are holding it at 210. So, I mean, above 210, you got to say, damn, like this could keep going. And, you know, in the whole idea with UPS was margin expansion, taking out the bad businesses, you know, and if you want to use us, you're going to have to pay more money, right? Different tiers of how they do it and different ways that they can make more money. They'll sell you on the next thing, or they'll take you this many miles, and you know they control it. Your package is on their truck. That's it, you know, and that is now part of that. Is if online becomes 10%, becomes 50% of someone's business, guess what? The most important part of your business becomes how do you get your product over there? And everybody just assumes, oh, you know, we'll just put it at UPS, and then they get upset when UPS is raising their prices. It's like, hey, look, everybody's got to get fed here, right? So I think these stocks, it's a monopoly. How do you value a monopoly? There's no U.S. Postal. Biden's going to give X billions of dollars. It's going to take years to fix the U.S. Postal Service. So you literally got two places to go, FedEx and UPS. And it's so bad, you know, that FedEx even kicked out Amazon, you know? So at some point, Amazon had to build their own thing. And everybody's saying, oh, well, what about Amazon coming in? Amazon's got to worry just about Amazon right now. FedEx doesn't even do Amazon. They don't even care about Amazon. It was such low margin. UPS, you know what this woman's saying? She's like, I don't know if we care about them either. You know, go figure it out yourself. Yeah. You'll see. You'll come back and you'll pay double because when we tell you get lost, you know, we'll see what happens. So anyway, that's what I think about these names. I wouldn't be surprised they trade higher. You know, you'd love to see a pullback, but that's really strong in UPS, and FedEx is climbing. I look, a lot of these stocks, I look at this market and, you know, I would say, I'll give you something that I think about every day, which is, you know, risk to the downside. You know, the idea that I'm looking at and what I'm seeing here is, okay, see right here, price going higher, MACD moving up. You see that?
Yep.
Okay. You sort of have this going on a little bit here, right? You see what happened? The MACD has, this is like energy. I call it like, you know, power, you know, stepping on the accelerator. You know, the MACD is moving higher, price is moving up. Okay, everything's good. Now, the market is basically saying, okay, we're going to let go of the gas a little bit. And we're going to allow the market to sort of find its range. The market did find its range. We've let go of the gas and the market stayed right there.
Mm-hmm.
Okay. So what do you think is going to happen when I'm ready to press on the gas again. What do you think is going to happen now?
It's a skyrocket.
Now the stock, these things could actually go way higher. So that's what I look at, you know, and say, damn, this market did not go down. And it allowed this amount of energy. It allowed, I call it energy, this power. It allowed this person who was pushing over here to relax. And think about this as, you know, another way to visualize, you know, people pushing, and then all of a sudden, like, all right, break time, and they let go, and they say, okay, let's see what happens. And when you push the rock, the big boulder doesn't start rolling down the hill. Guess what? It's probably not going to go. So the next time you go to push, you're going to be able to take the rock to the next level. You can think about it that way if you want. You know, but that's the way I think about this MACD. When I see sideways, which we've been seeing 416.5, 416, and this coming down, you know what I'm thinking? I'm thinking about the next time the accelerator gets pushed, and you know, you got to move from 420 up to 440, 450. That's what I see. That's what I'm considering. I keep looking at it. I keep saying, you know, what does that mean for commodity stocks? What does that mean for growth names? What does that mean for big tech names? What does it all mean? You know, if the market, you know, you look at Facebook, people reaching for $400 targets, $410 targets. Where does the S&P have to be on a $400 Facebook price? Jeez, a lot higher. A lot higher, right? It's not just Facebook is going to go up and everything is going to go down. You know, it could go up, but it's going to be some percentage of that move is going to be, you know, with the market. So look, this is what I see here. And to me, it's pretty bullish. That doesn't mean we're not trying to protect ourselves. In fact, what we're still doing is, you know, at Options Geek is trying to find names that are cheap. We don't want to get sucked into, you know, a move. You know, if you look at the IWM, which is more of this lower cap stuff. Let's see here. Go back. IWM It's the Russell. So small cap, you know, what do you see here? It's, you know, this could potentially be something that is also explosive. You know, you're in this range, and remember, markets go like this. This literally went like this and stayed sideways. Okay. And you got to respect that. And you got to say, okay, this is interesting development here. This took 3 months, and as they threw everything they could at it, and it didn't go down. And what does that mean? Well, it means that it's pretty strong up here. That's all it means. Keep it simple and stupid. It's strong. And where you want to, you might want to protect against 220, like 225 to 215 is 15 points, about 5%. You know, right now we have, you know, S&P put spreads, which are almost, you know, they're now 2 weeks out, a week out. You know, we're going to need something, but I'm trying to find the way we're trying to protect ourselves is trying to find cheaper stocks that have some sort of catalyst that on a move higher could actually move a lot, and we're not paying a lot for the options. It's one thing, it's hard to trade around in this environment, whether, you know, S&P looks very similar in this environment. It's hard to trade 100 volatility names because, you know, if it does this for 3 weeks, 4 weeks, it's hard to get your money back. And so the way you combat that is you go a little bit further out. You go 3, 4, 5 months, 6 months. You find plays where, like an Oxy, where $2, $3 can turn into 20, but it might take 6 months because we don't know what's happening right here. But we're trying to look down the road. So I think it's important to see that the market is pretty damn strong here. I mean, I think people can feel it. Momentum is catching a bid. You know, but I'm not sure you want to get sucked into momentum, which I'll just call it ARK is momentum. This is a big level right here. This is good that it's capturing, but we're going to the 50-200 day. And remember, it always just go do your homework. NASDAQ, the NASDAQ 100 back in 1999, 2000, 2001. Just go look at that, and you can see the same type of patterns where these things look. This thing looks like it's this. I mean, if you have any vision and you think if you have any positivity in you, you think, okay, it's coming back. This is what it is. And, you know, it came from 97 to 111. Why can't it do this? It certainly can. Just understand that it's when you're deleveraging, you know, momentum has a leverage function. When you deleveraging, this is what happens. It's these crazy types of moves, and you just don't want to go all in. I would suggest maybe finding, you know, some options that if you think it's going here up here, this is a humongous move from 111 to 150. So there is some plays that you could say, instead of putting down, you know, a bigger play right here for the next 2-3 weeks, why don't I just put a play for like 120, 145 if I want to play this long for a little bit of time, allow things to play out. Okay.
Right. Cool.
Wow. AMC 28 already. Jesus.
Crazy.
Wow. Okay. On that note, on 28, congratulations, AMC. What a victory. You know, hope it goes to 100 for you, and then you got to give back some. Don't forget. Right. Give back to the people who are, you know, there's a lot bigger problems than figuring out what the market is. So go do something good with that money.
Cool. Thank you for your message, Felix. Thanks for everything.
All right, guys.
Yeah. Bye.